Good morning, all. In particular, I'm very pleased that we were able to get Nick, Nick Atkeson of Delta Investment Management speak this morning. He has a partner, Andrew Houghton, who is not on this morning, but I wanted to recognize Andrew, and they are partners in their business. It is a registered investment advisory and is an outstanding advisory firm. They're both former hedge fund managers. They're based in Financial District in San Francisco. They're very accessible. I'd like to comment they have written a book, Win by Not Losing. It's an extremely important principle in investing. Just an example, if you lose 25% of an investment, you've got to gain 33% to get back to break even. So Win by Not Losing. It's still available on Amazon. And I'd invite you to take a look at that. Also, they have a really outstanding free weekly email that'll come to your in basket covering the markets. It's really a very good read. And I have a question for Nick as to how he'd like to handle the questions. You want to do them as they come, or you want to batch them?
I think we're going to start as they come, and then if we have to adjust from there, we will.
Okay. And you'll call the timeout if we need to take a break.
Yes. Hopefully,
All
we'll
right.
be on the edge of our chairs, and no one will want to break unless there's a medical
No.
necessity.
Yeah, I just want to again thank Nick for joining us. He and his partner Andrew are long-term supporters of our effort, and they really know what they're doing. They're great investors. Take it away.
Okay, thank you, Bill. So this presentation is called 2025 Outlook: Positioning for All Scenarios. I'm gonna give you a lot of I'd say specific securities information. They're not, they're not recommendations. So if you decide to act on them, that's your own choice, not Delta's choice. Um, but I think these presentations have more interest if you can come away from them with something you could look at and actually do in your own portfolio. So Delta Investment Management, as Bill mentioned, we came from the institutional side of investing, and institutions, mainly well for performance and for tax reasons, can be very tactical. And so what institutions will often do is, attempt to maximize gain and minimize loss. And like I say, which is different than a lot of retail investing, which is diversified investing with periodic rebalancing. It's not so much focused on changing exposures based on potential market environment. So Delta comes at it from a little bit more of a institutional tactical side where we're trying to optimize bullish cycles and avoid bearish cycles. And we have a variety of ways of doing that. As Bill mentioned, we wrote a book in 2013. So I have to tell you, this book is fairly out of date. As you know, the principles are good. The tools that we have at our disposal to execute Win by Not Losing today are much, much better. We published something called the Delta Market Sentiment Indicator. Barron's has asked, has asked us to give us this information, give them the information, and they put it in their weekly magazine. They've been doing it for about a decade, and it's a intermediate term price-based momentum signal that says either the market is bullish or bearish. We also publish it in our Friday email, which is, as Bill mentioned, is free. I'm going to show you that in a minute. But what's interesting about, let's say this, in the Barron's magazine, their market laboratory indicators, if you look at what's being published, it's, CBOE, Federal Reserve Bank, money rates. It's not from private enterprise. In other words, Delta Market Sim Indicator is a private company, and they want that information, and they have our phone number and email address right there. Anyway, the newsletter we put out every Friday morning is we try and keep it short. It does have some technical indicators at the end, including the leading economic index, the Atlanta Fed GDP estimate, market sentiment indicator. So if you're tracking those kinds of items, this newsletter will have it. Okay, and if you want this, all you have to do is you can send an email to info, info, at deltaim.com and just say sign me up. Or you can go to the Delta Investment Management or deltaim.com website, and there you can sign up for it as well. And anytime you want off it, you just unsubscribe, and that's the end of that. Okay, so we're going to talk about what we think might happen this year with the markets. And then, we're going to point out the problems with the forecast. And then we're going to talk about what do we do in any event, whatever the market forecast is. So the first thing to point out is, coming into 2023, the consensus expectation was there was a 60% chance of recession. In 2023, we had very strong growth and the markets performed quite well. 2024, we had another great year and no recession. Today, let's just say Goldman Sachs thinks that the chance of recession is about 15%. Well, there's a recession once every 7 years. That would, if you divide 7 into 1, that gives you about 15. So that just says that they don't, there's no unusual or greater than expected chance of recession. Some of the other recession indicators are still a little high, but all of that's coming down. And the consensus thought today is there is no recession. Just again, to say, how much is that worth, what the consensus expectation is? Probably not a lot, in that in 2023, 60% of the people thought there was a recession and we didn't come close to it. Okay. So, and we're going to get into why recessions are important, but historically, the two most robust recession indicators have been the Treasury yield curve and the leading economic index. And when we talk about the Treasury yield curve, what we're saying is the 2-year rate less the 10-year rate. The Fed can use 3-month rate. You can use, there are different ways of looking at that. But 2-year versus 10-year has been a pretty traditional way to do it. And when the 2-year rate is greater than the 10-year rate, the yield curve is said to be inverted. The longer the duration, the rate, the higher it should be to reflect that time risk. And, so an upwardly sloped yield curve is usually a positive thing. An inverted yield curve signals recession. And you can see this is a chart going back to 1980. Every time the blue line crossed below the black line, subsequently we saw a gray bar, which is a recession, until this time, where in the middle of 2022, the recession indicators fired off, and the yield curve's been inverted for 2 years. It's become uninverted recently, but as far as anybody knows, we haven't had a recession. So, and in fact, I'll just say this: in 2022, the first 2 quarters of 2022 were negative GDP back to back. Normally, that's what the sort of layman's definition of recession is. And oh, by the way, the S&P went down 25% and the NASDAQ went down 36%. And that is typical of recessions, that kind of market pullback, 2 quarter. But oh no, we didn't have a recession. So they'll figure that out. But in some sense, from our perspective as investors, that was a recession, because what we care about is what did the market do? And the market pulled back 25% and the NASDAQ pulled back 36%. So as far as we're concerned, 2022 was a recession. Okay, so since its inception in the 1960s, the LEI has neither failed to signal an eventual recession, nor suggested there'd be a recession that never came. So it's been 8 for 8 until now. All right, the leading economic index. So there's something called the Conference Board and they put together 10 factors that are supposedly forward-looking economic measurements. They've got different weightings on each of these, and they look at the percent change of these 10 economic factors month to month. And when the 6-month moving average of this measurement, the LEI, turns negative, you always get a recession. And just like the yield curve, it's always been right. It's never signaled false positive. It's always been right. Until 2 years ago, it went negative in the middle of 2022. It has stayed negative until last month. So today, just so you know, bring you up to speed, LEI is now positive, not the 6-month moving average, but we've had one positive month, and the yield curve has an upward slope. Okay, so why do we care about recessions? And the answer is this: the stock market behaves very differently during recessions, and not much else matters from a forecasting standpoint. And this is a way to show this. Now, this chart is, I think, one of the greatest charts. There seems to be a lot going on, but the basic concept is where you see these green horizontal bars, those are non-recessionary periods. And then the gray vertical bars are the calendar year returns of the S&P 500 without dividends. So you can see that if all you did was invest during periods that are green, you're almost always getting positive calendar year returns. And in the exceptions, the drawdowns are tiny. Okay, the red dots signify intra-year drawdown. So basically what it says is every year you get pullbacks. And that's common. Now, when you look at recessionary periods, that's the bars that are associated with these red marks. There's a red horizontal line, and then you can see both the intra-year drawdowns and the calendar year returns are much worse. They're terrible. So one way to think about it, let's say you started investing in 2002 or 3, and all you did was avoid 2008 and 9, you would be a genius. You would have great, spectacular returns. Another way of saying the same thing is if you started investing in 1999 and you avoided 2000 to 2002 and then avoided 2008 to 2010 and otherwise were buy and hold, you would be a genius. So it's a way of saying, how do we separate out just sort of normal volatility from scary volatility? Well, one way to do it is know, are you heading towards recession or not? And if you're not, you should expect to see standard deviation of about 15% in the stock market. Okay, so this is a chart of the S&P 500 since 1900, so very long term. And there are a lot of different things to look at in this chart. One is that, we'll start with one point, is that the market seems to stair step higher. So you have these long bullish periods, then you have flat periods. I mean, one flat period here is from the mid to late 60s to 1979, 1980. That was flat. We had 2000 to 2013. That was flat. And otherwise, you have the great bull market of 1980 to 2000. You have a bull market that's underway now. We actually, the new bull market, if you really want to be technical about it, started in 2022. After the 25% drawdown, which you could say is a bear market, we're now 2.5 years into the new bull market. Bull markets don't tend to last just for 2.5 years. They tend to go on for a while. So if that's all you knew, you said, hey, we're in a bull market and it just started 2.5 years ago, you would be bullish. Okay. Losses tend to be very concentrated. That's these down red periods. If you asked yourself, what's the worst calendar year performance in the stock market when there was not a recession, that'd be 1957 and 1966. And what that shows is roughly down 11%. So one situation you might find yourself in over time is the market's pulled back, that is down 11% on the year. but there's no sign of a recession, I would be a buyer because it says you've already factored in sort of the worst scenario possible for a non-recessionary period. Much of the risk has been removed. Consider buying. Uh, so this is an interesting chart. Okay. So the market from the low of October 2023 through, December or through October 2024 or December 2024, however you want to look at it, went up by more than 35%. And the next question is, after those circumstances or those conditions have been met, what happens in the next, does the business cycle collapse in the next 12 months? And the answer is no, it's never done that. And this goes back to 1928. So the recent low was, October 2023 through October 2024, we're up 36%. Should we expect a peak in the business cycle in the next 12 months based on this sort of historic information? The answer would be no. Again, we keep focusing on this recession question because in non-recessionary periods, you typically have pretty good calendar year returns. And when you don't, that's not bad. If there were a recession to come along, we'd take a very different view of things. Okay, so this is just a chart. We're about to go into earnings season. It looks like GDP has generally been better than expected. It looks like December retail activity was better than expected. So it's quite possible earnings are better than expected and that we see upward revisions. But this is sort of consensus earnings forecast for 2024, 2025, and 2026. And so there's growth. We've got good earnings growth. If anybody wants me to slow down or, like I say, let me know. So earnings growth. Now, one interesting thing about earnings growth, the stock market has been clearly led by the Magnificent Seven, these very large cap technology stocks. That's where all the growth has been. I'm going to just say this with a huge grain of salt. Where the growth looks to be in 2025 is in small cap stocks. The fatal flaw with that is if interest rates run up too much, this probably doesn't work. But one idea just based on earnings activity is that small cap may begin to outperform. We're not there yet, but it's shown signs of it. There have been moments of glory, very brief. I'll just say this. If you look at the Russell 2000 index, IWM, 40% of the index are money-losing companies. So there's a lot of not good stuff in small cap. The good news is there are sort of a lot of ETFs out there that are actively managed. I'll just say Fidelity, I think, has an excellent one. It's small cap. So you don't want to just Google Fidelity small cap ETF and you might see some ideas. In other words, I would say Pacer has ones that are based on sort of cash flow being positive, things like that. So you can say Pacer ETF, small cap, and you'll see some ideas there. But what I'm trying to say is I think a little bit like foreign stocks, small cap probably should be actively managed. This is this chart showing the amount of unprofitable companies in the small cap index is just enormous. It's 41%. And then mid cap is not too bad. And then large cap, almost everybody makes money as a large cap company. Okay, so this is capital expenditures expected from Google, Amazon, Meta, Microsoft, and Oracle. And you can see there's this explosion of capital expenditures. That's basically,
I don't know that.
oops, I can't say the word AMAZON because my speakers react. Anyway, but the point being, this, we're going to have a lot of corporate capital investment. It's a big move into artificial intelligence, which is also stimulating a big move in energy production, electricity demand, et cetera, et cetera. So there's a lot of money that's going to get spent, and it's hockey sticking up. What's kind of amazing, this chart to me is absolutely amazing in that if you just look at the magnitude in billions, 2014, honestly, not that long ago, you know, 23 billion, and now we're way up here at heading towards 246. It's just been a 10x growth rate coming out of this, and it's really jumping in 2025, 2026. One other point, and you can see it in their volatility graphs of the economy. There are all kinds of charts showing this. But what's happening is how we make what the components of our economy in the United States are becoming increasingly intellectual property tech. And the tech buying and the technology so far since basically, let's just say, I'm going to say since 1995 or 2000, there's no cyclicality to it. People are always buying tech. In a down economy, they buy tech. In an up economy, they buy tech. You're always buying tech. You're always investing in the new computer, the new processor, the new thing. It never stops. And so it's very non-cyclical versus old school building a factory, uh, buying equipment to manufacture cars or whatever it is, that's highly cyclical. So as the percent of GDP becomes more tech, the less cyclical we get, the fewer recessions we're getting. It kind of helps explain how is it possible that we had two negative GDP periods in 2022, first and second quarter, and yet there was no recession. Well, that's because technology just kept booming right through that period. It was basically technology prevented the employment statistics to qualify as recession. Just in the big picture, of course, I mean, just to explain that even further, we had COVID. They shut down the real world economy. You couldn't go into bricks and mortar stores. Everything moved online. Tech really ramped up. They thought that the move to online, that hockey stick up because of COVID was probably permanent. And so they massively overbuilt. Those stocks went crazy. Then a year or two into it, they rolled over because people realized, oh, they overbuilt. People are returning to bricks and mortar. The online trend is still positive and good, but it's not as strong as they thought. And so that pulled back. Anyway, so this is countries ranked by R&D spending. The US is just wildly beyond everybody else. China's the number two, but you can see there's nothing else close. So of course we're the leaders in innovation. One argument you always will hear is, why, the European markets look so cheap. The developing economy markets look really cheap. There's just sort of an absence of meaningful innovation abroad. So you're buying sort of more traditional old world economy stuff when you buy Europe and Japan. You're buying, it's always been commodities is what you're buying when you buy developing economies. So, in some sense, the very big premium we pay to be equity investors in the US is warranted because that's where innovation is good. That's where margins are high. That's where growth rates are high. Okay. This has changed a little bit lately, but the high yield credit spread is a view by the bond market of what's going on in the economy. And if there's fear in the bond market, basically junk borrowers, non-investment grade corporate borrowers have to pay more for borrowing. And the way they measure that is the spread between their rate versus the treasury rate. And you can see, this is going back to 2015, recently, the spread between borrowing as a junk borrower versus treasury was only 2.6%. Well, that means that the credit market thinks they're going to get paid back across the board. Doesn't make a difference how bad the quality of the company is. Everything's going to be great. That says, have no fear, economy good. We're going to get paid back. We don't need to put a lot of risk premium into the interest rate, if that makes sense. Okay, now one other thing about this chart I'll just point out. The magic number for are you in trouble or not, or when should you get concerned, is about 5%. If the credit spread, the high yield, and by the way, you can Google high yield credit spread, and you'll come up with the Federal Reserve of St. Louis. That's what that is, Fred. And you'll get this chart, and you can look at it all the time. They're updating it, almost every other day. Anyway, if this number is rising and it breaks up through 5%, you should be worried. But at 2.6, we're not worried, and you have a lot of room to move higher and not be worried. Okay. This is a chart just to show how absurdly wrong predictions of the market have been for a while, in recent history. And in 2019, we thought China was slowing down. We thought growth was fading. The S&P went up 31%. In 2020, we had a pandemic. The S&P dropped 36%. We ended up the year 18%. In 2021, we thought the pandemic would have lasting effects. The market went up almost 29%. In 2022, there was no recession. Things are great. We're normalizing. We were down 18%. In 2023, the chances of recession were 60%. It was going to be terrible. We were up 19%. Okay, that's the point. The point is that it's wrong, and it's not wrong by a little bit. It's wrong a lot, and it's wrong back to back to back to back to back. Now you can say it's because of, maybe it's because of distortions from the COVID response and a 42% increase in money supply and a bunch of stuff. And even today, people were borrowing at 2.5% and 3% on their home mortgages, they're very unlikely to sell the house because they've got such a great rate. So supply of housing is low. What does that do? That drives shelter costs in the current period today high because there's low supply and there's continuing demand for shelter. And so we have this persistently high shelter demand, which is the single biggest thing impacting inflation statistics. And it's still running at about 4.6% inflation every year. I mean, year over year on the shelter index. And that's keeping, like I say, the overall inflation number maybe higher than it should be, but that's one of those kinds of distortions that came out of COVID. All right, so let's talk about what's wrong with the market. Okay, so the most obvious negatives are high valuation, market concentration, and there has been some exuberance that's coming out of the market currently. Okay, so when I put this slide in, the PE of the forward 12-month PE of the S&P was 22 times. In this chart, it shows dividend yield, price to book, price to cash flow, whatever. It's all expensive. It's expensive at 22 times. Wouldn't it be wonderful if we could buy it 17 times or something like that? But anyway, so price is a big issue. This is saying we had the fourth highest S&P 500 trailing PE in the past 124 years. This is kind of now you could say, and I saw some charts even this morning saying we should just ignore all of the PE information until about, I don't know, 1995 or something, because what's happening in technology, our economy, like I say, is becoming increasingly tech-based, and companies like Microsoft and Oracle or Google are going to have much higher margins than Ford ever would. So, we have this huge operating margin expansion. We have much better growth rates. So a higher PE might be warranted, and we should be thinking not about, comparing it to what happened in 1945 or 1975. We should be thinking about what happened in 2015, okay, which is a higher number. Okay. Another sort of important issue is when you buy stocks, what are you getting paid to take on the risk? I mean, you could just buy zero risk bonds. I mean, today you can buy short duration treasury bonds that are paying 4.5%, 5%, and you can buy them as a fund. So you can get a pretty good rate, 5%. So if you're going to take on buying stocks, you should get something better than that. You should be thinking your expected, yield is going to be, your return is going to be 7, 8, 9, 10, something higher than 5, because you can get 5 without taking any risk. But today, the risk premium is negative. you're not getting paid to take on the risk of stocks. Okay, the same was true now I'll just before I get into what's wrong with this, but that was true in 2000, and then we had a terrible time in the stock market for the next 3 years. That was true in 2007, and then we had a terrible time in 2008. That was true in 2021. We had a difficult year in 2022, but it was also true in 2023, and this year we were up 25%. So this is not perfect, but this is to me a significant quantitative measure that makes you kind of have to say, should give you some pause. Whatever the experts are saying, you're not getting paid to take the risk. So how much risk do you want to take? Okay. We're back to price. When the forward PE is about 22 times, the subsequent 5-year return of the market is charted on this plot. And you can see as the market gets more expensive, that means we move out to the right, the average 5-year return gets worse and worse and worse. And basically because of price and one other factor, I think it might be on another slide, Goldman Sachs says the average return of the S&P 500 for an investor over the next 10 years will be average annual return will be about 3%. Vanguard says the same thing. What they're looking at is this chart. They're saying high price leads to low returns on average over the next, subsequently. The second problem, so you got high price, and then you've got, the top 10 stocks of the market representing, 37% of the market. And as these companies become multi-trillion-dollar companies, just as the law of large numbers, it's harder to get great growth. It's easy to make $1 go to $2. It's hard to make 3 trillion go to 6 trillion. So, just because of that large number resistance, let's call it, you've got a big price, and then you've got this resistance to accelerating growth. It probably decelerates and could become very normalized at more closer towards GDP growth rates. That's a worry when the PE is high, when the price is high.
There is one question if you'd like it.
Okay, I'll take a question.
What is the S&P PE without the MAG, any index ETF?
When you say MA, without the MAG 7, is that what this question?
MAG 7, yes.
Yeah. Okay, so I think it's about 17 times. I'd have to update. It's about 17 times. There are charts that show that. I don't have that chart, but it's 17, 18 times, something like that.
Thank you.
And one way to play that, just to say, okay, you go, all right, so the big ones are really overpriced. The 493 aren't. You could buy an equal weight S&P. The symbol for that is, I think it's PDP, Paul, David, Paul. Double check that. But there are lots of equal weighted S&Ps out there. Oh, sorry, it's RSP. Sorry, it's RSP. Ralph, Sam, Paul is the equal weighted. Anyway, so that's a way to play it. Versus going and buying, mid cap or small, we talked about small cap already, but one thing you have to always hedge against yourself. Like you might have an investment idea, but you could be wrong. So in your investment portfolio, leave room to be wrong. Meaning no matter how much we might worry about the very large cap technology stocks not performing, there's a lot going for them that's positive. And so I would never bet against them. In other words, I'd continue to have exposure. I wouldn't take exposure to zero there. That it's too good to not be a part of. Okay. Share of Americans that think that the prices will increase in the year ahead. This was recently done. And you can see it hit, this was done in November of last year. You can see how high it is. People got very, very optimistic. And as you guys know, with the AAII survey, which by the way is not showing this result, the AAII is not as bullish. But we know from that survey that traditionally when people get too bullish, it's a sell signal. When they get too bearish, it's a buy signal. If this were the only survey on Earth, then we'd be bearish. But this is not the only survey on Earth. I'm just showing it to you just so you know it exists. And then there's this behind it, which is this was done in December, and it showed the rolling 4-week flows into equity at 141 billion. This is going back to 2004. Do you see how much money was pouring into equities at the end of last year? It's crazy. It's way far beyond anything that's happened before. So people were getting pretty excited about the market, and they were throwing a lot of money at it. And a big chunk of it, by the way, was corporate buybacks. But that was a big number. If you say, okay, how much speculation is in the market? How much are we like, the NASDAQ 5000 bubble or some other speculative time? And to me, Robinhood trading is one way of looking at it. As you can see from the Trump election up to, basically mid-December, Robinhood went crazy. It was, crypto, lower taxes, things are going to be wonderful. Let's go after this. In the last several weeks, things have died down a lot, which probably is healthy. But there was definitely some speculation being built into the market at the end of last year. Okay, so we talked about some price issues that are negative. Now we're going to talk about economic negatives: stretched consumer, rising debt levels, falling savings rate. I'm going to pick up my pace a little bit. Fiscal deficits super high. Rate cuts less than expected by the Fed because inflation stays high and we have better growth. And we've been seeing a lot of that this last week. Labor market cooling, we have not seen that. And then China is slowing down. So household debt service is still very manageable, very low, but starting to move higher. This is debt payments as a percent of disposable income. Flows into early delinquencies. You can see autos moving up, credit's moving up. Student loan is down because they were forgiven, right? But you can begin to see delinquencies are starting to tick up. I mean, again, this is very early signs, nothing to worry about, but early signs. I mean, basically, as long as employment stays strong, probably not an issue. Federal net debt as a percent of GDP, significantly, out of control, heading higher. This chart, I'm sorry, it's blurry, but I think this is really, it's kind of almost, this is really a problem. And it's trying to say what's required to balance the budget and stabilize debt to GDP. And let's say we just talked about spending cuts, which are on the right-hand side. Well, if we could play with all spending, whatever type of spending it is by the government, we'd only have to cut 26% to balance the budget and 11% to stabilize the debt where it is. If we exempt Social Security and defense, now we have to do 44% cut or 19% just to stabilize debt where it is. If we exempt Social Security, defense, Medicare, etc., then we have to make a 76% cut in government spending. Sorry, never happening. Or a 34%, never happening, cut to stabilize the debt. Let's say, what do we have to do on the tax side? Let's say we looked at tax, we're just going to tax our way out of this. If we could raise all taxes, it's a 31% raise. If just to stabilize debt, 14. All taxes on people who earn over 200,000, it would be a 47% tax rate. All taxes above 400, it's a 74% tax rate. In other words, these are not solutions. This is not politically acceptable. The things that the debt is so high that it's really hard to imagine other than inflate and grow our way out of it. Okay, these are contributors to inflation. It's basically showing that inflation's kind of flat. It's not coming down as fast as it was, and that's kind of the issue. It's just kind of hanging in here, and lately growth has been better. Okay, for the markets in the last few weeks, this is the problem. The problem is the 10-year Treasury rate's ripping higher. We had a better ISM services index reading, and then we had a better employment report, and the 10-year Treasury rate went from 3.6 to about 4.75, which is a 52-week high. if it goes, if it goes to 5% or something, the markets are probably heading lower. This is one of these things that factors into the risk premium, right? So again, if you can go get high return out of riskless assets, and that's what's happening, then why do you buy stocks at a high price? You don't. So, so the way this gets defeated is one, that the rate stops going up, inflation starts to come down, and if growth continues to be quite good. Okay. So here's some investment thoughts. The S&P index. Okay, so over the last 20 years, you guys have all been a part of this discussion between active investing and passive investing. And, Vanguard said, well, why don't you just buy the S&P 500 passively at a low price and you'll outperform most mutual funds, et cetera. And that's true. I just want to point out that the S&P 500 index is, in my mind, not a passive index. It is a rebalanced index, and it takes in the best companies and pushes out the worst. It's also a momentum index, meaning it puts all the weight on the most successful, largest companies. As we know, the percent of the index it's dominated by 7 companies is a tremendous chunk. So when you're buying the S&P 500, you're really not buying into 500 diversified positions. You're buying into 20 or something. Momentum is a very powerful factor. So that's not a bad thing. You're getting a actively managed, momentum-based fund that everyone has to own, or everyone has to be measured against. So there's a tremendous amount of institutional buying of the S&P 500. It is a special asset. I like it. Everyone should own it. It's not your regular index. It's a good index. I mean, it's a great index. Okay. Risk is measured by volatility. Over time, up and down volatility will cancel out. So if you can invest for 50 years, you got no worries. 20 years, probably no worries. The problem is our time. We don't have that much time left, and so we have to worry about up and down volatility. By the way, the standard deviation of the market last year was 12. It was a very, very low volatility year. Every year, they always say, "Oh, volatility is going to go up." Well, it's actually realized volatility has come down in the last 2 years. So our problem is time. Okay, in bullish periods, I mentioned this, the market stair-steps higher. In a bullish period, the market tends to deliver double-digit average annual returns. People always say, well, the average return of the S&P 500 is about 7%, but that factors in long periods of time of very low, 3%, 4% a year returns, and then long periods of time of 11 to 25% returns. In other words, so you shouldn't think of it as like 7 is a sort of a bad, it's barbell. It's either going to be double digit or it's going to be pretty bad, pretty shitty. So there's that.
There's 2 questions if you want to take them.
Okay, go ahead.
Will we cover geopolitical uncertainties, tariff rhetoric, etc.?
Will they tariff what?
Tariff rhetoric from Trump.
Yeah. So I think the market response to Trump has been his primary interest in life is higher, strong stock market, strong housing market, strong asset prices, and that outweighs any other consideration, any other, campaign promise or anything else. So if his rhetoric becomes too negative for the markets, the thought is he will stop. He will change course and be market friendly. I think that's the part of the reason why the markets responded well to Trump.
The second question, Nick stated, as long as employment stays long, helps to keep the economy moving forward. Does it matter the type of employment, private hiring versus hiring by local, state, or federal government?
It's a great question. Okay, so employing somebody in a fairly non-productive, no bias, government job, let's say, that's maybe not as productive as a private job. There are plenty of private jobs that are pretty non-productive too. But if you can move those people into something that's more productive, that's good in aggregate, right? That's positive. creating lots of unemployment to remove, let's say, marginally productive people is probably a negative, right? Shoving money into people's pockets, however you do it, tends to create economic activity. Wouldn't it be better if government were efficient, not a drag, and we had a more productive economy? Absolutely. Is that going to be easy to implement? Not at all. Just so you know, as background, I used to work for Price Waterhouse, and my first role there was to implement A76 studies, which is a mandate by Congress that areas of the government that are non-strategic that can be done 10% or less, at a cost basis, at 90% of the cost of the government by the private sector must by law be outsourced to the private sector. Okay, so this was under Ronald Reagan, and we found huge chunks of the government, whether it was the word processing function of the IRS, whether it was the Consumer Product Safety Commission, whatever it was, completely inefficient, very wasteful, private sector much better able to do it. Not one element under Ronald Reagan, a very popular president, was ever outsourced to the private sector. I don't think anything. And part of it's because of the way government employees get paid. They get paid based a lot of it on how many people are below them. So the incentive is to hire more people, not be efficient, not create, there is no profit incentive. It's, get a higher paycheck, which is hire more people and then be a bigger, go up on the scale. Anyway, it's a long story, but the bottom line is I am not optimistic about creating huge efficiencies in the federal government. Okay, unless there's a tremendous crisis.
There's a couple more questions coming in. Can you recommend a good ETF or fund to track the S&P 500 index?
Yeah, IVV and SPY. IVV is the lower cost version. SPY is got a lot more volume, and big institutions use it because they need the volume. I would recommend IVV. India, Virgo.
You have commented on bond investing. Should bonds still be any part of a portfolio? And if so, what percentage?
Great question. So that's where we are right now. So I'm going to start back into the presentation if that's okay.
Okay, thank you.
Okay. So bonds. Okay, fixed income. Here's the way to think about fixed income. You have a starting yield. Let's say there's a fund that offers 7% or something. 94% of your average annual return over the next 5 years is correlated to that starting yield. So if the bond has a starting yield of 7% with a 94% correlation, you should expect for the next 5 years to earn about 7%. Okay. Well, right now, the PIMCO short maturity bond fund, these are ETFs, MINT. That's a ETF. Has a yield of about 5.3%. It's got no duration, so very low interest rate risk. So if you bought that, you should be thinking you might make about 5% a year for the next 5 years. PIMCO multi-sector bond. I like this one very much. It's owned by all the top PIMCO people. PIMCO happens to be the largest bond house in the US. These are very smart guys. It's creating about a 7% yield today. I like that one. These two at the bottom are incredible. SHOYX. These are mutual funds. They're bond funds, about 8% yield. SYFFX. Everything has risk. Make sure you check out the risk before you do anything. But it's about an 8% yield. So if you said to yourself, over the next, 5 years, I kind of can't handle the potential volatility of the markets and the uncertainty. You've got options today. The fixed income world is giving you plenty of good options. No matter what, don't be sitting on a pile of cash. Buy something, these high quality short duration bond funds like Mint, like GSST, I have in here 5.3, 5.3. Things change every day. Maybe it's 4.8, maybe it's 5, maybe it's 5.3, whatever. Pretty decent rates of interest for cash-like investing. There's a symbol BIL. If you really want something that doesn't move at all, it's a 1 to 3 month U.S. Treasury ETF, BIL bill. I think it's offering about 5%, and it literally trades like cash. High yield municipal debt, is offering attractive rates. These are, I think, are the two best funds in high yield muni. It's a Goldman Sachs fund, GHYIX. PHMIX is the PIMCO high yield. I assume there will be copies of these slides, so you don't have to write all this down, but this gives you federal tax-free, roughly after-tax equivalent of about 8%, low correlation to equity markets. Anyway, so I think those are good. We're talking about municipalities. They received actually a lot of the COVID money, so their balance sheets tend to be pretty good. So decent time to invest in munis. I like this. You've got electric cars, you've got cryptocurrency, which creates a lot of crypto mining activity. You've got artificial intelligence for the data centers. I mean, I'm not sure you guys are all aware, but I think it's Amazon just reactivated reactor 2 of 3 Mile Island, are working on reactivating that nuclear power, has a capability of powering 800,000 homes as one reactor, but it turns out Amazon's data center needs the same amount of electricity, so Amazon's going to use it all up. Point is, there's we're electrifying everything, and we need a lot of electricity. And it turns out that basically 65% of America's electricity comes from natural gas. Natural gas pricing is going way up, but the other thing we're doing is there's become a lot more activity in nuclear energy. And recently GE broke into parts and they split out their energy division called GE Verona, symbol GEV. And the stock's gone crazy. It went from 125 to 350, but it probably goes higher. It's a big diversified power plant player that does it all: nuclear, solar, wind, natural gas, whatever you want power. GE's got it. And oh, by the way, you really aren't going to be subject to any foreign competition because we're never going to allow the Chinese to operate nuclear power plants in the U.S. So U.S. it's very protected from foreign competition. I like Enterprise Product Resources. That's a natural gas pipeline company. Right now, the dividend payout 6.6%. It's tax. Put it in a taxable account, by the way. Don't put it in an IRA. It's tax-free payout until you get all your principal returned. They raise the dividend by about 3 to 5% a year. So over time, it keeps getting better, and it's in a very favorable situation. And it's not, it's near, it's definitely near 52-week highs, but relatively speaking, it's not all that expensive. Okay. For income, there are these buy right. So I'm now moving into the spectrum of, there are a bunch of new ETFs that have been created that, we talked about, we don't think it's going to be a recession this year. In non-recessionary periods, you generally get positive years. But whatever predictions are out there have all been sort of horrible in the last several years. So we need to allow ourselves room that no matter what we think about the world, we could be wrong. In other words, the typical investment bank for 2025 is saying the market's going to be up 7 to 10%. The average, the price target for the S&P by year end is roughly 6,500. That's about and that's based on earnings growth. So they're going to say the PE is going to stay constant. We're going to move up with the earnings growth. That's the forecast. Okay. Fine. Not terrible, not all that stimulating. Okay, so some ideas. You can do buy right equity. That's where you own, let's say, the S&P 500, and then they're selling calls against it. That's SPYI and GPIX. What's in the SPYI case, you're getting about a 12% yield. Okay, because they're basically taking the S&P and they're cutting it into a yield piece, they're selling premium and they're giving you some growth. The problem with it is that you're not going to perform as well as the S&P, but just if the market were to go down 12%, you would be flat because you collected 12% in interest, and that offsets that price decline. So it's kind of a way of saying I'm going to hedge the first 12%, or in the case of GPIX, first 8%, but I'm still going to be long. So in 2024, for instance, SPYI appreciated 19%. GPIX, which is giving you a lower yield, it was up almost 22%. So that's not terrible. It's going to work in an up market, but it's going to give you some income. If you're looking for, I want I still have interest in the growth element. There it is. here's more of the same. These are buy rights where they're selling calls against an index. In this case, it's the NASDAQ. So it's JEPQ, that's JP Morgan one, and then there's a Goldman Sachs GPIQ. Again, yields are a little higher, 9.5%, 10.5%, and that's because volatility in the NASDAQ's higher than the S&P. And so when they're selling premium, they're getting more premium. The implied volatility of NASDAQ stocks is generally higher, and so you get a little better yield. And you can see the return of JEPQ in 2024 was up 25%, not, very much in line with the S&P. Again, it's a NASDAQ-based position. And GPIQ was up 23%. So great, good returns in a bull market. So you have that ability to participate on the upside. You are getting a yield component. In some sense, the yield component gives you some downside offset protection, let's just call it. Okay. Here's more sort of value. These are a little weirder. JEPI was one of the original ones, JEPI. At one point, Delta Investment Management was the 7th largest owner of JEPI in the United States of America. Today, it's a multi-billion dollar fund, and we do not have the horsepower to stay the 7th largest owner. And not only that, we don't want to. It's a value-based group of stocks, quality, value. So it's not the S&P. It's not any particular index. It's a group of stocks they like. But still, it was up, 12.5%. That's better than the S&P Value Index, 8% yield. I'm hitting my hour, I guess, here. So if anybody, Bill, you can advise me if you think I need to break, but we're getting close to the end here. Buy right is actually a group of ETFs doing the same thing, selling calls and giving you a return in last year about 13%, 6% yield. Now, here's the thing I really like. It's the last slide. All right. So when you talk about hedging, the problem is hedging is expensive, and the more risk you hedge out, the more price you pay, and in some sense, the less absolute return you can get because you're putting all your money into the hedge. All right. So there are a lot of ETFs, lots and lots of them that hedge out the first 5%, 10%, 15% downside in the stock market. But as a result, they cap your upside. They say, okay, you can, for example, you have no exposure to the first 15% downside, but then you can only get a max of 7% upside over the next 12 months. Sounds good, but it's fairly expensive. I mean, this year you would have really not liked that result. And not only that, standard deviation of the market's about 15%. We get 5 and 10 and 15% drawdowns all the time, more like 5 and 10%, but sometimes 15, and none of those last very long. So if the market's down 5, 10, or 15, it's really something just to ride through and not worry about. It's when the market's down 30, 40, 50% that it matters, because when the market's down that much, generally there's something really wrong. There's a recession. We're going to be in this downturn for years. You're not going to make your money back very easily. I mean, for 2 reasons. One, the market's going to take forever to recover. And 2, as Bill said, if you're down 50%, you have to be up 100% to get back to break even. So you just want the insurance I think is valuable is I don't want to lose half my money. I don't want to lose 40% of my money, but I want to be on the upside. Okay, so these 4 ETFs provide that, let's say, disaster protection, to the extent they can, and give you great upside. So Aptus, ACIO, they're selling calls and they're buying puts, but they're out of the money. They're about 10% out of the money on the call side and the put side. This was up almost 22%. And the way you should think of it is it's going to be about, if the market goes up 1, this is going to go up about 0.8, or it's got a, 0.8 beta. But on the downside, if the market's down 50, it might be down 20, or if the market's down 40, it might be down 18, something like that. So let's just say half the downside, 80% of the upside. That is a great risk reward scenario. If you're down 18 or 20%, that's recoverable. If you're down 40 and 50%, that's a very difficult situation. And another thing is you want to be able to participate with the market in good periods. So these 4 ETFs essentially do these things. ACIO is Aptos. They're a group out of Alabama. They're attracting a lot of money. It now has a 5-year record. SFLR is Innovator. That they are the market leader. They were the first to come out with these hedged ETFs. That was up about 20%. JP Morgan actually has half of all hedged equity under management, and that's because they came out with a mutual fund a while back. And in the industry now of hedged ETFs, I think it's about $70 billion, 35 billions with JP Morgan. They came out with this HELO ETF. And then Fidelity has one, FHEQ. That's a really relatively new one, came out in April of last year. What's interesting is it's not just the S&P they're trying to manage a group of stocks and actually add value in the stock selection. And it's done very well. One thing I think about all this is each one of these uses a different methodology about how they buy the calls and sell the puts, and when they do it, and how they do it, and how they make the selection. That can matter a lot. For example, Innovator only buys quarterly, and it's rigid. It acts in a certain way every quarter. Okay, that could be good or bad. Turned out last year, the market tended to end high, at a high at every quarter, so it worked out fine. But you might get a different dynamic. So I like when you're messing around with, let's say, non-buy and hold securities or something that has some kind of methodology in it that's active. I like to mix up the methods because some methods might be working well one day and others another day. And so by diversifying not only asset type, but investment style, I'm getting even better diversification. I hope that makes sense. But traditionally, the way people diversified is asset type only, stocks, bonds, maybe real estate, maybe commodities, gold. Now, and what Dell has always felt is it's also style of investing. So you can buy stocks and bonds and be a buy and hold investor. That works very well a lot, but sometimes it doesn't. Bonds didn't work for years. In fact, the last 5 or 10 years, if you look at the average annual return, are awful. Stocks and bonds, the correlation can migrate towards one in periods of crisis. So the bonds that are supposed to protect you in a period of crisis may not. They go down a lot sometimes. So that's one way of working, and sometimes it works and sometimes it doesn't. Another way is to do these kind of puts and call positions. Another way is to actually, just sell some of the position when risk is elevated. Anyway, so there are a lot of different ways to do it. These are interesting ways. Right now, I'll just tell you, in our opportunity fund, which is kind of is there going to be a recession or not? And if there is a recession, be very defensive. And if there's not going to be a recession, be very long. We're only 25% naked long the S&P. We're 75% in hedged ETFs. And the reason is we think there's going to be, potentially a significant amount of volatility, and we'll get a better buying opportunity. And by owning this stuff, if the market were to go down a bit, we'd outperform, and then we could always transition more into straight long. So far, that's actually working out pretty well. But it also is a statement that, we're respectful of the fact that the market is very highly priced, and the world can be uncertain. So when the PE is 22 times and somebody says, I want to put more money to work, I feel better putting him into something that's got some downside protection than just straight long. All right, I'll leave it. That's my presentation for the day.
There's a number of questions pending.
Okay.
Okay, first, how is EPD taxed after principal is returned? Does it give out a K1?
Yeah, it gives you a K1, but their K1s are pretty timely, and it's 100% taxed after that.
As regular income?
Yeah. Mm-hmm.
Okay. Expense ratios on big bank ETFs, JP Morgan, Goldman, etc., are known for being very high. Any less expensive ETFs you can recommend?
Oh, wow. Okay. Well, okay, so I'm not sure. Okay, let's just start with index ETFs. The basis points per year charged are, range from 2 to 4%, 2 to 4 basis points. So very, very low. The SPY, again, S&P 500 index following ETF is, I think, I'm just trying to remember. I could look it up very fast, but you can go to morningstar.com and type these things in and see the expense ratio of all of it. I think it's 20 or maybe it's 9 or 10 bits, something like that, 9 or 10, more expensive. Okay, these things if these things have, and again, I can't quote you what their expense ratios are, but anywhere from 30 to 60 basis points, or 0.3 to 0.6%, I think that's pretty attractive, because I think these would be very difficult and rigorous and whatever for you to imitate this. In other words, I think they're giving you a lot for your money. And I think you're not seeing expense ratios 80 basis points or 1% or something crazy. These are things pretty reasonable. There's a lot of competition in the space. So I think that, I mean, again, I would have to if you go to morningstar.com and type them in, in other words, what I'm saying is, in the past, if you looked at a mutual fund that was doing something unusual and active, and particularly with an alternative asset like options or futures or anything, they were like 1.7%, expense ratios, sometimes higher. These are way less. So I think they're pretty efficient.
Is it beneficial to invest in commodities instead of bonds during inflationary periods?
Okay, so just my rule of thumb is if it doesn't earn money and doesn't have a dividend, I don't know if I want to own it. So I've always had a hard time owning gold. Let's just take that. I bought into the concept that copper was the new hot commodity. And Freeport-McMoRan, FCX, is the big copper mining company. And the reason why copper would be the hot commodity is because we go to electric cars or electric everything, we're using a lot of copper in batteries. And the amount of copper that's going in, that's demanded, is enormous. So I thought that would be great. But here's one thing you always have to remember with commodities. Whether it's corn, beans, copper, whatever, and again, the exception being gold because supply is limited, but a commodity is a commodity. And what that means is when the price goes up, they make more, and when the price goes down, they make less. So they tend to cycle pretty hard, and they tend to be not the best long-term investment. That's my own opinion. I don't know. Gold has done quite well lately.
Appreciate any perspectives on sectors and industries. Thank you for sharing views on the AI investment implications on energy requirements.
Well, I'll just say that the sector I'm most excited about is energy. I think that one of the biggest one investment theme was, hey, let's go solar, let's go wind, new energy, sustainable, clean energy. It's been an awful investment. And basically, one lesson learned is China killed us in solar. They make solar panels very cheaply. And so the solar business in the US has been crushed. And if you look at PBW, Paul Boy Whiskey, that's a clean energy ETF, very high quality one. It's a miserable returns. I mean, it's all negative, mostly because foreign competition. Just let's take Tesla. Tesla is getting killed in China. Apple, very exposed to China. When China decides to crush an industry, it will. So so that's one thought. Don't be exposed to things that are exposed to China, and China has a particular strategic interest in, because if you are, you're not going to make money. Number two, one of the beauties of energy, you just say traditional energy, is we're not getting off it. If you look at, I think we burned more coal last year than we ever have before. Transitioning away from fossil fuels is very, very, very difficult, and the tail to it is very long. But what we've done is we've said basically fossil fuels are a very big evil, and no new money should be invested in fossil fuels. There are many towns, there's towns, let's say some towns, that are saying no new gas stations. Okay, so there's no new entrance to the business. Capital investment is being tapered back. And when you do that, you create huge cash flow, particularly when demand is strong. So what has to happen with all that cash flow is it gets sent out to shareholders. So if, as a shareholder, as a buyer of financial instruments and in an attempt to make money, energy is really favored. And then, as we know, Ukraine, other situations around the globe, the more energy uncertainty there is internationally, the more favored the U.S. becomes. So I really like, I mean, in particular, nuclear and natural gas. The nuclear question is hard to figure out how to invest in it. It's got very long regulatory approval periods. There's a lot of new investment coming into it. I happen to, as full disclosure, I own GE Verona. I like it very much. I own EPD. It's my single largest holding is EPD. I think that there's a possibility as people, we drive NVIDIA and AI stocks very high. Remember, the story of chip stocks is always the same, whether it was Intel in the 90s or AMD or pick a chip stock, they get hot, competition enters, they go down. Now, NVIDIA may run for a long, long, long time, but eventually these chip stocks, I mean, look at Intel, it's been a terrible investment. And it's not like we don't buy PCs and laptops and whatever else. So it's a tough area to be to be dominant in for long, 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 long periods of time. NVIDIA is going through just a very favorable situation, and that could persist for a long, I'm not trying to tell you to sell NVIDIA or anything, but I'm just saying but it gets to a very high multiple. Meanwhile, these energy companies, a lot of them are trading at, below 15 times earnings. And somebody may go, well, wait a second, we can't have all these data centers and do all the things we want without energy. And it could be you get multiple expansion. So if you got multiple expansion plus higher payouts to shareholders plus rising growth rates because demand is increasing, you got a pretty favorable investment situation. And it's also should be pretty non-economically sensitive. So if you did get a recession, you're still there earning your money and ticking along, and things should be fine.
Your thoughts about QFLR?
QSLR.
QF, Fox.
Oh, QFLR?
Yes.
Can I cheat? What is that?
Innovative NASDAQ managed floor ETF.
Oh, right. I would have to go look at the specifics of that ETF. Okay, on the managed floor so anytime they say managed floor, I might be okay. Oh, right. Sorry. Pause. I know what QFLR is. QFLR is the sister of SFLR. SFLR is managed floor innovator ETF working off the S&P. QFLR is the innovator managed floor ETF working off the NASDAQ. I like it. Sorry about a pause there in my thinking.
How do you determine the fraction of a portfolio to hedge?
It's sort of based on your risk tolerance. I mean, and what obviously your investment horizon. If you're 25 years old, go ahead and put all your money in the market and you're going to be fine. Today, again, very much dependent on your time horizon, your risk tolerance. I personally, at this level, I like hedges. I like these fixed income investments yielding 8%. I'm playing more the batting average of after a couple years of 20+% returns in the S&P. I'm okay if I can get another 7-10% type return and manage my downside. A lot of times when the market goes down a lot, the advice is, well, go ahead and put a lot of money in. This is a great time to buy. But the typical problem is you have no money. You've just watched it burn up in the market. So not a bad idea to sort of maybe build some capital to be opportunistic with in case things do get more difficult? I mean, we've just gone through a long period of very, very low volatility. I don't want to be the next guy to say, well, volatility is going to pick up, but volatility may pick up, just moving back to longer term average type volatility. So I'm being a little less aggressive this year.
What about SPYG and SPLG?
Now here we go again. Can somebody give me a hint on FPYG? What we
SP, oh, SPYG. Offhand,
I could cheat. I will.
growth ETF.
Oh, okay, yeah. So the S&P index, SPY/IVB, is called a blend. Blend. You can buy the S&P growth, or you can buy the S&P value. If you buy the blend, you're basically getting a very heavily growth weighted index because so much of the weighting is in the top 7 stocks. If you buy the growth index, you're just weighting it even further to the growth. I mean, to the 7 largest stocks. If you buy the NASDAQ, you're weighting it even further. So that you're just taking all you're saying is, I want to own more Mag 7. So I'm going to go from blend to growth. And then if I really want to jump it up, I'm going to go to NASDAQ 100. Okay,
Go ahead.
that's it.
Have you looked at buffer funds for hedging volatility?
Yes, so that's what I was mentioning. A lot of the funds we talked about are hedged. Some people use the word buffered. The buffer, the real buffered ETFs, there are lots of them, tend to protect you for the first 5, 10, or 15% downside. My problem with that is that you give up too much upside. There are times now, as the market's moving around, these things get priced on a day, and it says, okay, on this date, based on where the market is, you have 7% upside and no exposure. Let's say, I'm just using as an example, for the first 15% downside, the first 10 or whatever the number is. And then the market goes down a lot, right? That security is still out there. But now if you were to buy it in the down market, it would say, oh, you have 15% upside, but your downside protection is only, let's say, 3%, because you're much closer to where it starts to break through the bottom. But maybe the market's already down, so you're getting a little change. I mean, there are times when you can time it and maybe get a little advantage, but I'm not a fan of giving up so much upside for what I call common downside, 5, 10, 15% downside, which I don't think is unusual. I don't think it's worthy of a hedge.
Please give some suggestion for conventional energy ETF or how to search for them. Any comment on SpaceX, defense sector, flying electric car, drone?
That's a lot. Okay, so on the energy ETFs, there's a lot you can look at. Let's just take oil. You can buy oil diversified, which is basically Exxon, Chevron. You can buy oil services. You can buy MLP ETFs. You can buy. I would just Google energy ETFs. I'd just type that in and see what you get and see which components of the energy world you want to be exposed in. There's, like I mentioned, there's renewable energy, clean energy. There's MLPs, which is the midstream. There's exploration and production. There's oil service. There's so there's a lot of stuff in energy. I'm biased towards natural gas, midstream, and nuclear where you can find it. That's what I like. But okay, the other question. Okay, what was the other?
Any comment on SpaceX, defense sector, flying electric cars, drone?
I have no comment on flying electric cars, drones. I don't know how to invest in that. SpaceX, I'm not involved. I don't really follow that one, so I can't really speak definitively on it. I mean, clearly what's going on is the government is outsourcing a lot of its launch need. So that's so there's that. And then you said SpaceX, flying cars, drones, and there was one other thing I thought.
Defense sector?
Oh, defense sector. Yeah, again, I'm not in favor. It's too geopolitically driven. So, you know, Raytheon or Lockheed Martin or whatever, I'm not doing. I think Boeing is interesting though. Boeing has been destroyed by bad manufacturing, you know, plane difficulty, strike, et cetera, et cetera. And, you know, at the end of the day, we're not letting Boeing go away. Boeing is of you know, strategic importance to the United States of America, that we have some involvement with manufacturing aircraft. And so, you know, over a longer period of time, I think Boeing is an interesting buy.
There's a thank you for clarifying on the energy and protection aspects. Very insightful. Next question is, how about Bitcoin as an investment long term?
Okay, so you know, we live in Silicon Valley, and you say, okay, look around you at all the, let's say, call them platform companies you might have missed. I mean, I think Buffett missed Amazon. I missed Meta, because I'm not a Facebooker. I just, you know, it came out public and then it went way down and then it went up and then now it's a monster. You know, it's gone back to being a monster. And I mean, in other words, it's Bitcoin is a particularly tough one because uh, again, you're talking about buying and selling something based on essentially what other people think of it, and not much else. I mean, I really have no idea. It seems it's definitely gaining traction. There's no doubt. There are major investment houses, you know, whether it's Fidelity or whoever, creating ways to trade it, be involved with it. So there's a lot of interest in it, and there's expanding access to it. So it's probably in a very favored position for a period of time. That's basically what I have to say. Is like, I think it's, you know, Trump likes it. You know, it's in a good spot for the moment. I don't know what to say about it long term. I have no idea. Is it going to become a new form of currency? I don't know. I don't know.
How do you determine Barron's hedge amount?
Oh, okay. So basically, we started a long time ago with something called capital appreciation. It was a strategy that got either in the market or out of the market based on the market sentiment indicator. Just real quickly, you know, before regulation full disclosure, that is before the year 2000, a lot of information got priced into securities. So every trade that was done through a person. They were all the institutional trades, whether it was, you know, MFS, BlackRock, Fidelity, whoever, if they wanted to buy and sell stock, they had to call a brokerage desk and trade. And there were these large trading floors, and we would write out paper tickets and run them in and scream out the orders. Okay. Meaning there was a lot of information on these trading floors. You knew who was doing what. Okay. So just forgetting anything else, you knew large institutional holders selling Microsoft. Okay, that tells you something. The other thing you knew is that the way research was conducted before 2000 was what I call relationship research, meaning the institutional analyst was talking with the CEO or company management, and they would say, well, I don't think the quarter's so good. And then the analyst would go tell the top clients of the brokerage firm, quarter not so good. And they would begin to sell, and the stock would begin to roll over. And then they would tell the intermediate sized clients, and then they'd tell the small clients. And so the stock would sort of go up or down based on what the information was quietly behind the scenes. And then when the company made the announcement, the stock wouldn't move much because the only people who didn't know was the retail investor, which wasn't enough to move anything. Okay, so they outlawed that. You can't do that. When a company releases information, it has to go out to everybody all the time. So now you see these giant periods of volatility on earnings, which you go like, come on, how can somebody be surprised by Boeing's earnings? But they are. Okay, and so things move around more on these announcements because none of it's getting priced in the market. But the point of all this is to say, pre-2000, when stocks moved around a lot, there was a lot of information in it. And people used to say, everything you need to know is already priced into the stock. All the buyers and sellers have expressed their opinion by what the stock's doing. That is so much less true today. So the point is, in the Delta Market Sentiment Indicator, which had its roots in 1971, used to mean a lot. When that thing went bearish, it was very important. When it went bullish, it was very important because it was using all the information that was priced into stocks, and there was a lot of information in stocks. In the last 25 years, there's less and less information priced in stocks. In fact, the percent of high frequency trading being driven by computers is now 60 or 70% of the flows. And the analyst is no longer a buddy of the CEO. He's a guy who came out of a good school and studies in the library. So it's a totally different world. And analysts can't get paid for deal flow. They can't get paid. So the pay has gone from millions to, not so much as compared to what it was before. So you get a different situation, and the research doesn't mean much. Anyway, the point is the Delta Market Sentiment Indicator used to be a more powerful indicator. Today, it still has power, but in different places. But getting to the question now, how do you decide how much to be hedged or not hedged? Well, in the old days, we would be out or in. But today, with these hedged ETFs, we can be much less market timers. We can just increase our exposure to hedged ETFs and decrease our exposure. So what we're doing is we're becoming less actively traded and becoming more hedged. But at the end of the day, the real, so there's an answer which is, hey, when the market looks risky, we should be more hedged. When the market looks less risky, we should be less hedged. We look on the capital appreciation strategy that's mostly based on the Delta Market Sentiment Indicator. In the opportunity strategy, it is based on macroeconomic signals. But at the end of the day, there's going to be a judgment call. And the question is, what are we giving up to be hedged? And does that feel like a good trade-off in the current environment?
Can you comment on NVIDIA?
I personally, I missed it. Like, damn, how did that happen? What's so impressive about NVIDIA is it was in about 5 or 6 quarters, it went from nothing to enormous. And in my mind, in some sense, while it was going from nothing to enormous, it really wasn't talked about much. It wasn't like there was a lot of like, oh, you have to own NVIDIA or anything. Now everybody has to own NVIDIA. There's a lot to the story. I don't know it well enough, but it sounds like the keys to it are, one, it's innovating way faster than anybody else. 2, there's a software component to its chips, which is going to be a reason for making it more sticky. 3, you have to say, well, it's now a multi-trillion-dollar market cap. What's the likelihood the stock's going to, do what it did before? Very, very low, but will it be a good stock? Probably. I mean, I forget, maybe it was Bank of America or somebody came out and made it their top pick. Maybe that was Morgan Stanley. But anyways, there's still got a lot of fans, and it's fundamentally doing fine. So I have no problem with it.
What's the fee structure for Delta?
So typically, we charge 1% per year, billed quarterly. So it's 1% annually fee rate.
While managing funds using Delta using ETFs, can I request using options part of the hedge instead of the floor funds?
Not really. I mean, we do have some very, very large clients. We go out and buy independently, we buy options, and we mess with options directly. But no, I mean, here's Delta is more and more a wealth manager. So clients come to us and they say, here's my situation. How can you help me? And then we create a kind of a custom response for them. We have a case where we do buy some very long dated S&P 500 puts as a hedge, like leaps, but that's very small. And that's not something I want. We don't really want to do that, to be clear.
When you say wealth management, what type of assets, how much assets is that normally?
Okay, so to own a Delta strategy starts at 50,000, we have accounts that are, 50, 60 million, and we have accounts that are, let's say a lot of people have 400 or 500,000 with us, something like that.
Okay, that appears to be all the questions that are in chat. If anyone else has a question, you should be able to unmute and I'll give you a couple, and we can take a couple minutes to see if there's any other questions. Nick, could you put up the slide for your book? There's been a couple questions about it. Thank you.
I want to add one last comment, just a plug for Delta. So, active tactical managers come and go. And that's all, even long-term capital came and went. And a lot of that's because they think they've got a great idea and then it doesn't work. And then they go away. Okay. So to be playing this game after the decades that we've been playing it says something, which is we had to learn a lot about why things don't work in investing. And another thing, particularly for engineers, is they want a mechanized, repeatable, rules locked down, never changes, stick it in the blender, press the button, out pops the output approach. But that doesn't work over time because the world changes and you have to mix around, you have to be moving along with the change. And sometimes it's hard to see the change, but if it's not working, it's not working, and move on. So I'm only saying that, and so one thing that's good about Delta is that we have been around for a long time, and we've seen what doesn't work, and we're getting much better at making things that work.
Mm-hmm.
There's one more question that came in. Do you think the big disaster in Southern California will have a big effect on the economy, especially in California?
Usually these are stimulative effects, right? Because you got to go and rebuild everything. I think one thing that's really messed up, and we got to figure out what to do, is insurance. Where the insurance companies can raise rates at any rate they want, and they only have to insure the risk they want. And so that's problematic. Insurance has been a great place to invest. If you look at the like Progressive, PGR, it's incredible because they constantly are raising their rates and they're constantly reducing their risk. And so but at some level, it's not meeting the insurance objective, which is people need insurance. So I don't know. So the first thing I'd say is it's probably stimulative to the economy. It probably is a growth additive, actually, that we have to rebuild LA. But I do think the insurance industry is going to become much more subject to regulatory risk.
Is your firm and industry pressing for government to allow tax deduction for investment portfolio management fees?
We're not involved in that.
Will possible tariffs from the administration impact the markets?
Potentially a lot. Yeah. It depends what the tariffs are, how much they are, if they're inflationary or not, yeah, it could. Again, it's, one thing we've learned is a lot of things get said, a lot of things seem very scary. There are a lot of things out there. But until something happens, it's really hard to, it's a complex world. So it's hard to know exactly how it's going to act in the market. And oftentimes you're best off waiting and finding out in some weird way. In other words, let's see how this goes in other words, forecasting very unpredictable events is often kind of a non-winning strategy in the market. You can, and also making long-term forecasts is not a winning strategy. In almost some sense, it's like you get up every week on Monday and you go, well, what's it look like this week? And you do it again the next week. And you do it, and you just try and make good decisions every week. And don't get knocked around too badly by, short-term volatility, but be constantly evaluating. It's a never-ending process of what do we know now that we didn't know 2 seconds ago, and how does that impact what we're thinking? Generally, though, a lot of this is you just not an issue for investors.
Is that a good or bad thing that the insurance industry will be subject to more regulation?
Well, I think fundamentally, if you're out trying to rebuild your house, how do you rebuild if you can't get insurance? I mean, what happens to property values and all kinds of things? So I think, if you're from the perspective of I'm a person who needs insurance, it could be quite good. If you're somebody who's been doing very well owning insurance companies, because like including Berkshire Hathaway has been doing very well, they own Geico. It may not be so good.
Yeah, the link for the webinar recording will be sent to the email address of of what you use to register with Zoom. So I'll send that out when it's available. There will also be posted on our website somewhat after the link is sent to the attendees. If an investor has funds for you to manage, do the funds have to be transferred to a bank or broker of your choosing?
They pretty much have to go to Charles Schwab. We do have accounts at Goldman Sachs, but we think Schwab's better.
Okay, the questions appear to have stopped. There were far more than I expected.
Nick, thank you very much. That was a great presentation,
Okay, thank you.
wide-ranging and very to the point of what people are thinking about and wondering about.